Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So it finally happened. Finally, we've got the US Fed have said we are going to cut into interest rates by 50 basis points, and they've done it. So what we want to know now is how does this impact investors like yourself or myself? What can we expect moving forward? Is this going to have a huge impact in our day-to-day, portfolio management, or do we have to change things, or can we just leave the things the way they are and continue and so on? So I'm going to try to answer some of these questions, and I'm also going to give you 7 different companies that could potentially do an basically low interest rate environment. What I mean by that is, if the Fed continues to cut in the next year and a half, then what companies will do better, and what does that actually mean for us as investors, and what does that mean for the general economy, especially for the US? And remember, the US economy affects a lot of the Europeans and other places, so we want to see basically where that's heading right now. As always, before we get to that stage, we're going to talk about everything I've just said. Can we please join the Patreon account if you can? If you can do it, please join us. It will cost you about 15p per day, and you get a lot of things out of it. You get access to the Discord. You get access to where a lot of brothers are sharing very good practices on a daily basis, especially when there's a lot of news going around. And you get access to a lot of the things like the dividend trackers. You've got the news, you've got the 10 high quality stocks, you've got the watch list, you've got loads of things there that are frequently posted. And on top of that, you get the family update of the family portfolio, as well as this portfolio, all the buys and sells that I regularly make. So we'll definitely appreciate if you can join us on there. If you can't do that, just join us on the journey, and just make sure you are a subscriber to the channel, like the video, to make sure it goes to a lot more brothers and sisters out there, inshallah. So I just want to give you a little bit of information before we look at these 7 different companies. Okay, so we've now in an situation where the interest rate is being cut, and it's probably going to happen a few more times, of course, because they need to bring it down as much as they can, because of course when it comes to inflation is still high, and they need to make sure that it goes back to basically where it belongs. Okay, and right now there's a lot more people over the last year and a bit that did not actually purchase a brand new house, brand new cars, and so on, and their mortgage rates went up massively. A lot of things have happened to change in terms of the consumer behavior, if you like. So one of the things that's going to happen, that's going to change things, okay, is the fact that now the interest rates are lower. It's going to encourage more people. Okay, so what we want to see is what are some of the elements the sectors that will do well, because now consumer might feel a little bit better than they did if basically a couple of months ago. And the reason for that is because if the interest rates are quite low, people are more likely to go and purchase that house, that car, that basically device that they were after. Okay, and the consumer discretionary companies then will tend to do well. That sector generally will suffer when the economy is not doing well. People don't feel good about their investment, basically, and their money, and so they're thinking of, do you know what, I'm only gonna buy the essentials and that's it. But now the interest rates are coming down. Hopefully they will start looking at buying a new car, homes, or just doing up your home nicely, or whatever the case might be. Real estate tends to do well as well, because it's now cheaper to, of course, borrow from the bank and so on. So for that reason, these companies that are actually, house builders and companies that are doing like a house refurbishment and all of those things will start to happen. Okay. A lot more people will start buying. It's not going to happen overnight, by the way. I'm not saying in the next month everyone is just to go to the bank and get a loan and buy a house and this and that. Well, we're not saying that, but over a period of time when the interest rates are very low, especially when interest rates were almost at zero after COVID, a lot of basically companies, a lot of people were buying all sorts of things, and then when it went up, they suffered quite a bit. Tech does well as a sector. The reason they do that is, remember when interest rates were increased, that the companies that suffered the most, especially within the first few weeks, were high-flying tech companies, because they get a lot of money from the bank. They get a loan from the bank. They use that money to, of course, do a lot of more research and development, actually increase their productivity and so on. Now, those companies have suffered a lot since then, because if interest rates so high, it makes no sense to actually get a loan to actually basically invest in your business. Now, with interest rates coming back down, these companies could potentially start looking into getting loans so they can actually maximize basically their potential, right? Financials tend to do well as well from the lending side of things. Of course, it does not help the banks because they can't charge a lot more in the interest and so on, but they can get more money from the lending part of it, because if people are buying cars, they're buying houses, they're buying electronics and so on, they're going to need the money. They're going to go to the bank. They're going to get basically a loan from the bank. For that lending side of things could potentially help them. Now, these are some of the growth, the types of stocks that will do really well. So we've already said growth stocks because that rapid basically growth side of things, that they can now get more money from the banks to actually grow the business very basically quickly. Dividend paying companies do well as well, because if interest rates are coming back down and the bond yields are not as good as they were before, of course, then what is going to happen? The dividend paying companies will become a lot more attractive. So dividend paying companies will now, especially those that are yielding slightly 3% or more, probably become more attractive, and as time goes by, the all dividend companies will do well overall. And then there's the cyclicals, that are the consumer discretionary companies that we talked about earlier. When the economy is doing really well and everyone has got a bit of money and everyone is getting jobs and things look good, interest rates are very low, then cyclical companies, of course, would do well, especially the consumer discretionary companies. They will start doing well because, of course, there is a lot more money coming to their pocket and so on. And I'll share with you 7 different companies, like I said in the beginning. Okay, but all of these things are amazing, but anything can happen, anything can change it over. Okay, but always make sure the fundamentals of the businesses that you're investing with, okay, are solid. Don't just buy it because they are the new shiny, sectors that is going to boom because of interest rates has come down. You need to do your research and understand what you're buying. So that was just to kind of give you an idea of what might happen in moving forward. But what we are interested as a long-term investors, okay, is buying high quality companies. Hold them in very, very long term in your portfolio. Don't worry about the fluctuations of the economy, the stock itself. If you've done your research and you invested in a really high quality business, then why are you worried about basically what might happen today or tomorrow? Because some of these companies, if you know you're going to hold them to them, for the next 10 years, why does it really matter whether interest rates are 0 or 10% right now? So what I'm going to share with you guys is companies that could potentially do well over a period of time, according for the basically that do well during low interest rates. Okay, and the first one is Home Depot. Simple. Okay, everyone has got a little bit of money lying around. They're gonna go basically buy products from Home Depot so they can do up their house nicely. They want to do their garden, they want to do extension, all these things that they're gonna do, and Home Depot will definitely benefit. Home Depot is one of those companies that's been around for quite some time, very profitable business, and as you can see here, when it comes, they've got excellent free cash flow right now. The free cash flow compound annual growth rate for the last 10 years, last 5 years, we're looking about over 8%, which is great. Total return 17% in the last 10 years, and growth estimate next year they're expecting about 5%, 4%. If the economy starts to change, okay, that estimation will start to change as well, but it is really expensive right now. So 38% premium right now, very, very expensive. Pays solid dividend as well, so 2.3%, which is quite nice. So this will become very attractive because that yield is very good, and then of course the fact that they have been increasing that dividend is quite nice over the last whatever years. The next one that we're looking at is Sherwood-Williams. Sherwood-Williams is one of those, the painting company, so it goes well with this company. Okay, when it comes Home Depot, Sherwood-Williams, they are in that sort of industry where basically people are buying these products from Sherwood-Williams that basically they are sold inside Home Depot, and they have basically their dividend is not actually great. But again, we're not really worried about that dividend right now because we're not saying we want the income right now from these companies. What we're interested in is really this growth. And can you see 18% and 16% of the last 5 years, which is absolutely amazing. 45 years of increasing that dividend. That's what we're after. And it is safe dividend, 87%. And as you can see here, they've got free cash flow, $2 billion. They've got 5% when it comes to the last 5 years in terms of the free cash flow compound annual growth rate. Total return 18% over the last 10 years, and growth estimate for the next year, we're expecting 12%, 11% after that, 63% premium right now. Again, another very expensive company. And the next one that we're looking at is also goes with the home side of things. Okay, this is Halal companies. This is one of they basically make roofs for houses and so on. Anything to do with construction material, this is the company to go to. As you can see here, they have a very small market cap right now of $20 billion. Now, dividend yield we're looking about is just below 1%, and the increase is absolutely amazing. The payout ratio is 80%, and the latest increase was 18%. The 5-year is 16%, and 47% of increase in that dividend. So next year, this company will basically become a dividend king if they are part. I'm not sure if they are part of the S&P 500, because that's one of the rules is they have to be part of the S&P 500. Right now, you get $4 for every share of this company you own. 99% is the safety, which is absolutely amazing. When it comes to revenue, they're not growing it really fast, but when it comes to EPS, it's 41%, which is absolutely amazing. So it will be interesting to see if that's organic or not. But profit margin, return on equity, and return on invested capital, absolutely fine. $1 billion of free cash flow right now, almost 18% when it comes to the free cash flow compound annual growth rate, 19% when it comes to total return, and 13% and 15% expected to grow that earnings about 15%, which is absolutely amazing, and 23% premium right now, but it is very expensive. So all of these three companies are trading really high multiples right now, very, very expensive. Now we're done with the home builders. Let's have a look at all the home kind of side of things. The next one that we're looking for is this one here, and it sells nutrition, sweeteners, that sort of product. And again, if the consumers are feeling good about themselves and everything is great, the sweeteners are not very cheap. I've checked some of them. And then the nutrition side of products, so people start looking after their health and so on. It's a very small cap, basically. By the way, small caps do tend to do well during when there is a low interest rate environment. Okay, so it's about 9 billion market cap right now. It has a narrow economic moat, $136 per share. Dividend yield, we're looking at about 2.4%, and the payout ratio is only 34%. Latest increase was 3%, and the 5-year growth rate of 4%. Now, in terms of free cash flow, looking for $1 billion of free cash flow, which is absolutely amazing for a company that has a $8.8 billion in terms of market cap. That's really good. So 31% when it comes to compound annual growth rate for the free cash flow, right, last 5 years. Total return was 7%, which is really good, and they're expecting the earnings to grow about 7% for the next year, basically. Fairly value right now, $122 per share. Right, the next two, I'm going to do both of them at the same time. Now, if we're all feeling good, we've got cash around basically in our banks, we're going to go and spend some money. And then who makes money from that situation? Of course, the Visa and MasterCard. These two companies will benefit from basically markets that are basically the economy that's doing well, because there will be more of us out there spending money, and every time we spend money, we use a card that was manufactured by these companies, and the transaction was facilitated by these companies. And as you can see, in terms of dividend, is not there, but dividend growth is absolutely amazing. They're increasing that dividend nicely every single year. The safety was 99%. In terms of revenue, and basically the EPS is growing nicely. Profitability is absolutely amazing. Free cash flow, wonderful. Now, total return in the last 10 years is exactly the same, absolutely amazing. And the growth estimate for the next 5 years, where they're expecting about 13% for Visa, 19% for MasterCard, and both of them are fairly valued right now, 272. Okay, right now as we're looking at 285 and 465. Right now we're looking at 493. And finally, another one that will definitely benefit, because of course from humans side of, can't even talk, human resources side of things. So if people are being hired, companies are hiring and so on, and of course the company who's going to basically process all that data for them is automatic data processing. Okay, 113 billion market cap. It has a wide economic moat, $277 per share right now. The dividend is quite nice. It's over just 2%, which is quite good. The payout ratio is actually quite low right now, and they have increased that basic dividend basically about 12% in the last 5 years, which is quite nice. And they are definitely a dividend king. So 50 years of increase in that dividend. The annual payout right now, we're looking at $5.60, 97% safety when it comes to the dividend safety side of things. Revenue and the EPS is actually growing nicely. profitability side of things is absolutely amazing. So look at this: profit margin almost 20%, return on equity of 93%, and return on invested capital of 60%. There's not that many companies out there other than these three that can basically do this type of things. Okay, $3.5 billion of free cash flow right now. That's 11% in the last 5 years. So the compound annual growth rate for 11% when it comes to free cash flow. Now total return in the last 10 years, we're looking about 14%, 9% expected to grow, and it's about 9%. Fairly value right now, $280 per share is where they think the price should be, which is absolutely amazing. So 280 right now is 277. Okay, so it's coming back down. So if we see quite a dip on this company, I will definitely be loading up again, because I think I do own about 25 shares of this company. Now quickly show you the Sharia compliant side of things. There's nothing to worry about in any of these companies. They are all basically Sharia compliant right now, according to basically the standards that was set by the AAOIFI. And that's it. That's what I wanted to share with you guys. So I would definitely not be changing any of my basic investment philosophies on things that I've been doing right now, because of course the economy might change. This might happen that if everything basically goes back to, if interest rate go back to zero and these companies benefit, I'm just going to continue but dollar cost and averaging into the market every single week, like I've been doing over the last 4 years, and I'm going to continue doing that, inshallah. Yesterday the market went up massively because of the news and whatever, and then what happened, the portfolio didn't even move. I think it's a lot to do with the FX impact, which is absolutely crazy for us investors in the UK. But there you go, that's where we are right now, and I'm going to dollar cost average into these companies that I own every single month, inshallah. I have my own watch list and things that I basically built myself. I check that, and if it meets with the criteria, then of course I will be buying that week, inshallah. I will keep updating you, inshallah, as much as I can. Please join us at the Patreon account where you can. Have a wonderful day. Assalamu Alaikum.